Hey, Brett, are you ready for your trivia question today?
Oh gosh, we're still doing this?
Yeah, this is our new opener, so I hope you've been studying all random financial topics ever.
That's right.
So, since it's my favorite time of the year, which is tax season, I was going to ask you a question about taxes.
Okay.
So, this was the last data I could find, but what was the average tax return in 2015?
So how much they filed for? How much
People got back?
Okay, so like $1,000?
It was actually $3,100.
Oh, that's more than I thought, obviously.
I was really surprised. I thought it would be quite a bit lower than that. And I think this is like kind of a good reminder to remind people, yes, it is really nice once a year to get some money back from taxes, but this could be your money all year long. So what I mean by that is you can check your deductions. So if you've been claiming 2 deductions for federal, you could drop down to 1, and then you'll get a little bit more on every paycheck and a little bit back at the end of the year. Because essentially, if you're getting $3,000 back, it means you basically gave the government a loan for almost $300 a month, every single month, and then come April, you finally get your money back, but you didn't get any interest on it. So if you get that, in your wallet instead, you could be investing it. So instead of getting it in a lump sum a year later, you could be getting it every paycheck.
Right. And it's kind of a double-edged sword too, because if you're on the other side of that coin and you don't pay as much or, pay as much out of your paycheck toward the taxes, then you have a big payment maybe at the end of the year, right?
Correct. Yeah. So I, try to tell people, keep trying to find that sweet spot. So every year when you do your taxes, if you're like, oh, I'm still getting some money back, take it down a deduction. Obviously, if you get in the neighborhood of $500 to $1,000, one side or the other of you either get a refund or you owe, you probably don't want to crank it in either direction much more because, might balloon it. And I don't want people to be surprised on tax day. But, if you're getting a refund of $3,000 and you have 2 deductions, if you take it to 1, you're not going to owe money still. You're not going to go from getting $3,000 to owing $3,000. That would be a very weird circumstance that would happen. But I do want to, remind people if something is changing, like if you were getting, deductions for childcare or something, and then that's going away, that's not a good year to change your deductions, right? Because that's going to throw off the whole equation.
Mm-hmm.
But if things are staying pretty consistent, for us, we're married finally and jointly now, and we've been that for a couple of years, so we kind of know now, like, what our average annual taxes look like, and we can adjust from there. So it helps with all sorts of planning. And speaking of planning, that's what we're talking about today. We're talking about, it's the start of a new year. What are some things that should be on your checklist going into the new year to plan ahead and have like your best financial year yet, right?
Yep. So things you should review annually, kind of look at, take a fresh start at the beginning of the year, get yourself set up for success by just taking a look at some of these things or setting some things up that are going to run all year long that are going to get you in the best position at the end of the year.
Exactly. So I'm just going to kick right off. We shared very recently our spending for the year. And I encourage everybody to do the same thing. So, if you haven't used Mint, then sign up for Mint. So it'll make it a little bit harder for you this year, but you can download all of your bank statements and kind of go through your transactions as best you can and get a feel for where all of your money went. I think, kind of pairing that with taxes, you see how much you actually made throughout the year. And that surprises a lot of people. They're like, oh my goodness, I had no idea that where did all my money go if I made this much? And being able to kind of see a breakout of here's where your money went. And, I have this spreadsheet that I've used for budgets that breaks it into a pie chart. So you can literally visually see like 25% of my money went to this one category. Is that worth it or not? Right?
Mm-hmm. Shopping. Right?
Oh, come on. I do not shop that much. Well, I mean, we can let the listeners tell us, right? Because we put everything out there. So, but yeah, it's just a really good time of year to review your spending. And kind of on that same note, it's a good time of year to sit down as a couple or, if you're an individual, to sit down and make some goals to be like, did I get closer to my goals or further from my goals this year financially? And, I think a lot of people are like, well, I, pay for these things because it brings me joy. Well, this is a good time of year to be like, did that, coffee every day on your way to work actually bring you joy or not?
And it doesn't have to be anything crazy, right? I mean, if you're starting out from making goals that you've never made before or have never followed any goals before, I mean, start with something like very high level and just like see if you can stick to it, because you'll start. Every time you make a decision or every time you are interacting with some kind of money transaction, you're going to think about that goal regardless of what it is and say, oh, maybe I shouldn't, do this thing. So you don't have to like restrain yourself and like try and fight for it all year long. If you're brand new to it, it's not something high level like I just want to save more money this year, right?
Yeah.
Than I did last year, and like have a dollar amount that you're shooting toward and be like, okay, I don't know how close I am to that dollar amount right this second, but do I need this thing, and would it be better off to be hitting my goal rather than have this thing?
Exactly. And I think on this podcast we really always try to discourage impulse spending. So one area I do that is any big purchase for the year, I kind of think about starting in January. So if I want new kitchen appliances or if I want to go on vacation, I think about that in January and I put that on my radar so that I can pay for these things with cash. And that's a huge goal for anybody to have, and one I strongly recommend. Like if you want that new TV this year, great. You don't get it tomorrow, right? You get it when you can afford it with cash. Maybe that is tomorrow. Maybe you've been saving for that. But, for a lot of people, that's a good place to start, is get a big item that you want, whether it's a vacation or a TV or a new computer, whatever it is, kind of put that on your list and then be like, okay, I need to save up this much money. And then it's really nice because you can set a goal for when you want that item. So maybe I want the new TV in time for your birthday in May, right, Brett? And so then I'm like, okay, I have 5 months and it's a $500 TV, so I need to save $100 a month. And that makes it so much more manageable than a month away from your birthday. I'm like, okay, I'm going to buy you a TV this year. And I'm like, oh, God, I have to come up with $500 now, Mm-hmm. So I think, that it's really just a strategy for peace of mind of you can attain anything you want to, but you have to put a little bit of planning into it. And if you do that, you're going to be successful way more often.
Yeah, just planning ahead just slightly. I mean, in that example, that also helps with a double whammy maybe of, you might be able to get out of debt with that same strategy if you have credit card debt. If you're only going to buy things with cash from then on and you're never going to add to more of that backlog of that debt, it's eventually going to go away if you continue to pay it off.
Yeah,
right?
Exactly.
Yep, So just it depends on your goals and what you want to do and what you think it is. But setting up some goals at the beginning of the year, and I hate making goals personally, but having something high level is just helpful to guide you on the right path for the entire year.
Yeah, and one thing to speak on, if it is credit card debt, we've talked about paying off debt in different episodes, but I think that's why it's so important to track your spending, because if you have $3,000 in credit card debt that you're trying to pay off, and your goal is to pay it off by the end of the year, and you're like, but how am I going to come up with $300 a month? When you sit down and review your annual spending and realize that you spent $400 going out to eat last month or whatever it might be, all of a sudden you can be like, okay, if I just cut, not even all of that out, but if I just go out to eat less than I was, I can pay off my credit card debt. And for some people that's not worth it. You want to be able to keep going out to eat, but for a lot of people I've talked to that want to get out of debt so badly, that's a very easy decision to make. And so once you know where your money's going, you just have the power to make these decisions.
Yeah, because for some people that's just one. I mean, even if you cut it back once a week, I mean that's a significant amount, right? Like for some people that's 25% of the time they go out to eat. Yeah,
and where I work, a lot of people still buy lunch in the cafeteria, which is on average about $7 a day. Well, that's $35 a week, which is about $140 a month. And that's something that a lot of people, they just get in the habit of doing that, so they don't think about it. Well, if you all of a sudden, if you just switch to peanut butter and jelly for lunch again, or whatever it might be, you could easily save, half or more of that. So that's $70 a month just by making a pretty easy thing where you just weren't thinking about that before because it was just the normal routine, right? And so I think that's the whole thing with finances is if you sit down and think about it, it's very easy to make these decisions. You just have to be aware of your situation.
Mm-hmm.
So, all right. So we talked about, kind of setting some goals. Another thing that you could do is this is a good time of year to sit down and rebalance your 401k. So taking a total 180 here on subjects. But we've talked about 401ks before and investments and how to pick funds. And, if you missed that episode, basically, every 401k will have so many funds that you can pick from. Depending on the company, you might have 5 funds, you might have 100 funds, right? But, you can kind of review them. You can see what the expense ratio is, which I know that always sounds like, a ratio or something, but it's actually just the fee that they charge you. And then you can also see past fund performance, and you can see what, stocks make up that fund. And I always recommend of having, based on your preference, people always talk about stock to bond ratio. We're very aggressive, so we do 90 to 95% stocks and 5 to 10% bonds. We're young, we're still in our early 30s, late 20s, and we're really comfortable with that high risk. Some people are more comfortable with an 80-20 or 75-25% split. It's totally up to you. And then even within that split, there's large cap funds, mid cap, small cap. We did do a whole episode on this, so I'm not going to go into too much detail. But, you can read online or listen to our podcast and kind of understand what some of those different funds are. But the whole point of this rebalancing that I'm finally circling back to is you have these funds and you picked these funds initially. But over the course of the year, you might have been like, okay, I want to be 95% stocks and 5% bonds. And then over the course of the year, you find that you've shifted to, especially this year, we had such a crazy market, you might be at 99% stocks and 1% bonds because that fund grew so much faster that, the growth of your bond fund didn't keep up. So what rebalancing means is you're going to carve out some of that from the stocks and get back to that 95-5% split that you're looking for. And where this is, extremely important is as you get older, you might want to be 60% stocks, 40% bonds. Well, if you haven't rebalanced it in a few years, you might be more closer to 70-30, right? And that's pretty far off from your goals. So I always recommend once a year kind of look at the funds that you selected initially and see where you're at now, and then just go ahead and rebalance and get closer to where you want it to be.
Okay, so that's new to me. I thought it was rebalancing to just check to see what better funds were out there that were added to the portfolio or what got updated or swapped out and see, pick the best things. But it's really the markets themselves are readjusting that. So it's not like me going in and setting the setting for I want these percentages and it's going to give me these things and it's going to stay that way. I just get to pick the things that are out there and set it at that time, and it's definitely going to change over time.
Yep.
So I just need to go look at it and make sure how I set that up in the first place is still what is out there today.
Yeah.
So maybe I don't need to change anything, but maybe I need to adjust things very slightly just to get back to where I set it up originally.
Exactly. Because when you buy a fund, we can take myself for an example. I started working when I was 22 and now I'm 27. So I've been contributing to this for 5.5 years. So what I put in 5.5 years ago, if you look at stocks, they've about doubled in price in that 5-year time, or close to doubled. So if I was looking for a 95 to 5% split or 90-10, I'm not going to be there anymore. So rebalancing is just going in and making sure you still have that bond cushion, or, even within stocks, I mentioned that there's large cap funds, small cap, medium cap. It's not like you go into a 401k and you just pick 2 funds and one's stocks and one's bonds, right? Mm-hmm. There's multiple different funds. I personally have a collection of about 5 to 6 funds that I put my money into in my 401k. So I kind of know, I want 40% in large cap and 20% in mid cap. And please keep in mind, this is just illustrative example. I'm not telling you what you should be doing with your 401k. But even between large and mid cap, it might have gone from the 40-20 I wanted to 45-15. And so it's just rebalancing all of the funds to try to get back to what your original goals were. And, it's a great time to be like, have my goals changed? Mm-hmm. I started working 5 years ago when I was 22. Maybe I'm not as comfortable being as aggressive as I was then. So maybe I want more in bonds, right? So this is just a really good time of year to sit down and, again, review your goals and see, where you're at and make sure that your retirement is on track. So,
cool.
All right. So kind of staying on that same note, this is also a good time to remind people that what the contribution limits are for 401ks. So you can contribute $18,000 a year per person to your 401k. Now, for a lot of people, you're like, holy crap, that's so much money. But I want to remind people that, if you're making, let's say you're making $100,000 a year, which I know many of our listeners are not quite at that salary. Just for an example, if you're making that much money, we've talked about this before, but I always get the question, should I be investing in traditional or Roth? Well, really, it comes down to what your tax rate is right now. And if you're making $100,000 a year, your tax rate is quite high. When you go to retire, you can live on $50,000 a year, which means you're only going to be withdrawing $50,000 a year, so you're only going to be earning $50,000 a year. So your tax rate is going to be lower. So if you get a traditional 401k right now, you're just going to end up paying less taxes. And since that's taken out pre-taxes, you don't really notice it, right? If you crank it up another couple percentages to try to get close to maxing out your 401k, you're not going to know. It's not like it's dollar for dollar. It's not like if you crank it up 2%, it's not going to be 2% of your paycheck because it's your pre-tax amount, right? So it's a really powerful savings tool that I recommend everyone put as much as you feel comfortable putting into your 401k as you can.
So again, if it's I want to go traditional if I'm making more money now than I would be making when I'm 60 years old.
Correct.
Right? Or more money than I'm going to be spending when I'm 60 years old.
Yeah, that's a good way to think about it. Or, it depends on your earning level. So let's say you are entry level right out of college and you're making $35,000 to $40,000 somewhere. Roth might be your friend because odds are, even if you don't think you're going to be spending more later on, with kind of lifestyle creep and all those sorts of things, and inflation alone, you're very likely going to be taking home more money in your retirement. So it's different for everybody. There's not great rules of thumbs out there, and there's a lot of arguments. Some people think the tax rate is going to go up in the future, so everybody should do Roth. I tend to think, look at your personal situation and, kind of think about it a little bit for you. And yeah, good rule of thumb is, will I be likely earning more or less money in my retirement than I am right now?
But the higher you get in that income bracket, the more likely it is that you should be looking at traditional. Right?
Correct. Yep. All right. So then another tool to save for retirement. So I recommend, the investment order kind of reads like this. You should be investing in your 401k up to your employer match. And then a lot of 401ks out there don't have great fund selection. So what I mean by that is they pick their own funds, and then their expense ratios or their fees charged are rather high. They're, a lot of companies, they're sitting at 1% or 2% for a lot of their funds. Well, me, I love Vanguard, and my company fortunately offers Vanguard in my 401k, which means my expense ratios are 1/10 or 1/20 of a percent, right? So it's huge difference. But if you are looking at your expense ratio and you're like, oh my gosh, they're all really high, still put your employer match up, right? So if they give you 6%, put 6% in your 401k. But then another really great tool is you can save money in an IRA. And I know we've talked about IRAs before, so it's just an individual retirement account. It's the same story. You have a traditional and a Roth amount, but these ones are subject to income requirements. Once you make so much money, you can't contribute to Roth anymore. But the standard rule of thumb is you can put $5,500 a year in these IRA accounts. And good news, you can get some tax benefits for these if you're making contributions with post-tax dollars, and then you put it into a traditional IRA. And you can still contribute for 2017 to save yourself some money on your taxes before you file them.
Yeah, until April, right?
Until April, yeah.
You can backdate them.
And I would probably say, for a lot of places, different brokers have different rules. So you might have to get your contributions in by like March 31st for them to get the statements and everything that you would need
processed. So where do I go to sign up for that? I got an IRA through my bank, I think, or my credit union when I was 16 or something. I started contributing to one, something like that.
Yeah, so I wouldn't recommend that because your interest rate was probably like 0.002%.
Well, yeah, probably.
So, I typically recommend, especially if you're younger and still saving for retirement, that you get a, mutual fund type. So I would go to Vanguard or Fidelity or American funds, or, if you're lost on all of this stuff, Vanguard is probably the number one choice. Their expense ratios are so low. But, I started with American funds because I didn't really, I was 19, I think, when I started my IRA, and I didn't really know much about anything at that point. I didn't know much about which funds I should be in, what my balance should look like. So I worked with a financial planner, and their fees are a little bit higher, but if you don't really know what you're doing, you get the advice, which I think can be very, very valuable for a lot of people. Mm-hmm. And you also have, so if you do Vanguard and you self-manage, which, people with a personality type like myself can do that. But there's a lot of people out there who they might panic when the market goes down, or maybe they were saving this money for retirement, but then, the Tesla 3 came out and they just had to get on that waiting list. And if that's your personality type, it's better to be in a fund, go through a financial planner and have somebody who can kind of be your conscience and be like, no, you're not taking this money out, right? So there, there's a lot of different places you can get them, and I just recommend people shop around and find the right answer for them. Typically, credit unions probably aren't going to, certain banks now are partnering with different investment companies to be able to offer mutual funds at a bank. I haven't heard of credit unions doing that as much. So I think they're typically going to put you in a CD, which if you're young, you're not even going to keep up with inflation. Right. So I don't recommend that route. But, good on you for starting at a young age. And so if anybody's starting to save this money, the great news is you can always roll them over. So if you have an old one that you kind of forgot about that's sitting somewhere else, you can, get on Vanguard's website and fill out a form and roll it into their funds, which is great.
Yep. So once it's in the IRA family or umbrella, right, then it's your money no matter where you take it, right?
Exactly.
So you can take it wherever you want. It doesn't matter. Yeah, so I started it with a credit union. I'm sure they were using some kind of provider. I don't even know what it was, right, at the time. And then when I started working with my company and started working with a financial planner, then I rolled that into, which I now have like in American funds. So I have my 401k accounts in American funds. I have my IRA account under American funds. It's all on the same screen there. It operates basically the same way. They're just broken into two different technical breakdowns.
Yeah, exactly. So yeah, that was a very good point that you made. It is your money, but the catch there is to leave it in the IRA vehicle. So
yeah, you move the whole vehicle.
Yeah,
right,
don't take it out of that account and put it in a savings account, right? With IRAs, they grow. The beauty of them is, let's say you get a traditional IRA. The money goes in tax-free, and then it grows tax-free. So year after year, you're just like compounding this money at a crazy rate because you don't have to worry about taxes on it until you decide to take it out. And then when you take it out, you just want to make sure, once you get closer to retirement age, you want to have a strategy for withdrawing your money to make sure you're minimizing taxes, right? But for now, leave it in that vehicle. It's a great vehicle. It's one of the few things the government has done a really good job with. All right, so the last one on my list for annual contributions is an HSA. So this one you can't, as far as I know, you can't really do any extra contributions for 2017 now that we're into 2018, but they did up the limit. So for individuals, you can put in $3,450, and for families, you can do $6,900. And this is a health savings account, HSA. It's tied to high deductible plans. So if you have a high deductible plan at work, it means your deductible is higher than usual. Usually high deductible plans will start at a $1,500 deductible and go all the way up to a $10,000 deductible. But it does mean you can contribute to these nifty plans. And these ones are pretty great because they have 3 tax benefits attached to them. The money goes in tax-free, it's accrued tax-free, and when you use it to pay for medical expenses, it is not taxed when you take it out. So these are really great tools and something I recommend a lot of young people to look into if they've never have before. And it's a good time of year to, a lot of insurance plans have already done their signups in the fall. But you might still be able to get in and revise your contributions to these accounts if you are like, oh, wait, I want to, I said I was only going to put in $10 a paycheck, but, I want to put in $20 a paycheck, right? So it's a good time of year to just review that and make sure you have the right amount of money going in.
Yeah, I definitely think my company, there's certain things they lock down and you can only change your benefits one time a year, but that's usually like selections for, I want to be on the high deductible plan.
Correct.
Not necessarily how I'm using that high deductible plan. That's a little more flexible. Maybe that's an email, or maybe that's just a form on a website that's some pre-built portal or something that I have access to.
Exactly. And, another cool thing about these HSAs is there are HSAs and FSAs, and I think a lot of people get them confused. An FSA is an account that you can put money into, and you have to use it that year for medical expenses. But anybody can use them. You don't have to be on a high deductible plan. But HSAs are accounts where you put the money in, and if you don't use it at the end of the year, it does not disappear. It is your money. It's your money forever. And you can, when I say HSA, it's not actually through an investment company. These are at banks. So, mine is at a local bank, and the money's there, and if I wasn't happy with the bank anymore, I can roll it into a different bank and keep it in that HSA vehicle. And the beauty is you can only contribute so much a year, but there's no cap yet. Maybe they'll add one in the future, but so you could put in, $3,000 a year for 20 years and have $60,000 in this account, and then you don't really have to worry about medical expenses, right? So this is something else that's also a really good tool when you think of retirement planning, because obviously health insurance costs are really high in America. But if you can save while you're working and then all of a sudden you retire, you can actually use these accounts to pay for premiums. So if you need to get on a plan that's costing you $1,000 a month, but you saved $60,000 while you were working, then, you have 5 years of premium saved up in this account to help you bridge the gap until you get on Medicare. So, All right. Well, I think that's most of what I wanted to cover for an annual review. So to kind of summarize it up, just go ahead and review your spending, review your, start getting your tax documents in order so you can do your taxes. Oh, I actually did want to talk about doing your own taxes a little bit. So are you comfortable doing your own taxes, Brett, or have you always kind of passed that off, or how have you handled that?
I've done both. I've been trained to do business taxes as well as personal taxes. It's all, forms that have line items, and they jump from line items, and the instructions are usually annoying but very easy to follow. The processes are never that hard. The people that do them themselves are always like, yep, super easy, anybody can do it. That is pretty much true. But a lot of people just don't want to even worry about it, right? They don't want to look at it. They don't want to look at the forms. They don't want to try and figure it out. They don't want to pull the documents out. They just want to hand somebody maybe a box of stuff and then say, go nuts, and, tell me whatever it's going to cost to do it.
Yeah.
But I think we switched to using TurboTax for the last couple years instead of filing manually. And that is super, super easy to use. It's stupid how easy that is to use. They cover everything. They cover all the bases. They cover all potential scenarios. They just walk you through the process and just ask you questions. Like, did you do this year? Did you maybe do this year? Did you get married? And if so, then here's all these things. And then at the end of the day, boom, it's done. Here's your number. Probably most people would overcomplicate taxes as well because they think, they have all these things, and, if you donated anything this year, you've got this receipt, and, they're going to give you something back in your taxes for that, and, your mortgage is going to be in there, and you have to deduct that, and maybe so there's some other deductions if you have kids or something like that. But then most people, at the end of the day, still end up filing standard deductions regardless, which is just one checkbox.
Right.
Says, I didn't make enough money in deductions to qualify for, itemizing all of my deductions, so boom, checkbox, it's done. That's the whole form. That was all my taxes. And that's most people. And if most people are so afraid to do that, then they should really take a look at it and see how they qualify, or see how somebody else did it to say, did you just file standard? Then why did I just pay you $150?
Yeah, and I want to remind people, even if you don't file standard, like Brett said, it is that easy on TurboTax. They're like, did you buy a house? Get your form out and look at this line item and enter that amount into this box, and boom, you're done, right? It's not, even if you don't file standard, it is not that hard to use TurboTax. And for, TurboTax is always running specials, and if you make under a certain amount of money, it's free. If you file standard deduction, I think there's a time period in which you can hop on and do it for free. Otherwise, they have some very low-cost products as well. Like you can do your federal and state for $39.99 or something like that. I haven't checked into the pricing this year, so this is all based off last year. They might have increased their prices. But I would say a lot of people, even for us with real estate, which adds a whole section of paperwork that we get to, fill out because we are landlords, we walk away paying, I think it was $79.99 last year to file our taxes with TurboTax.
Right, filing and everything. Yep.
Right, and to, have our small business on there even. So,
yep.
To me, to file two people's taxes with a business, and that included state for both of us and city for myself, we would have been charged way more than that going to any CPA around town. So, I encourage people to look into it because it's really not that hard. And actually, this is a great time to mention that the tax bill that Trump signed on December 22nd, which I know that date ingrained in my mind because it made work harder for me, but that will actually increase the standard deduction. So even right now, if you're, maybe with your mortgage interest and your donations, because you're just so charitable, you eke over that standard deduction amount of, I believe it's in the neighborhood of $6,000 to $7,000 for individuals. But I'm pretty sure everyone is getting doubled. So all of a sudden, a lot more people are going to fall into this standard deduction bucket. And that's actually good news because it makes your return very, very, very easy to do.
Yep. So you can look at all the numbers, but if you're not even close to it anyway, then boom, you're just going to check the standard deduction box that says skip to the end, and you're done. Right?
Yeah.
Yep.
Exactly. It's like those tests that you took when you were a kid where it was like, read all the instructions first, and the last one said, just write your name on it and take a nap on your desk and you get an A or whatever. And then you'd have the kids who didn't read and they were like, oh my God, this is so hard, and they're trying to figure out all these terrible questions.
Yep. Yep, so, that's exactly what that's kind of, the whole tax process in a nutshell, exactly.
Yeah, so don't be fooled. Taxes really aren't that terrible. So, take a stab at it. And, maybe you just, you could fill everything out on TurboTax and not click submit this year and pay to get it done elsewhere and see if your numbers match, right? And if they do, then great, you could have done your own taxes, Yeah,
and I know some people are scared of being audited or whatever, right, and making sure that they didn't do it right and whatever. I mean, don't be so afraid of that. And even if you use a system like TurboTax rather than a CPA firm, those services also offer audit protection as well if you want to do that. I mean, it's a little bit more money to just get covered by that, but in the event that you get it audited, they're on the hook for handling everything. They provide you with a consultant to do anything that you need to do. I mean, they take care of it all. So
exactly. All right, so now I will recap everything. So, start getting your tax documents in order. Even if you're going to pass it off to somebody else, you still need them all in that box. Go ahead and review your spending for the year. This will help you set goals for next year. If you have any big expenses on the horizon, maybe your roof started leaking, start planning ahead. It helps tremendously, and it'll help you stay out of debt to plan for expenses ahead of time. And then go ahead and rebalance your 401k and make sure that your contribution levels are where you want them to be across, all the different tools of 401ks, IRAs, and HSAs. So I think that covers, most of what you should be looking at this time of year. If I forgot anything or you're like, hey, what about this, other investment I'm using, go ahead and drop me an email or let me know, and I will put my contact information in so you can reach out to me. All right. Thank you.
Thanks, guys.
Hey guys, thanks for tuning in to this week's episode of Money in the Bank. Make sure to subscribe to us on the iTunes or Stitcher app so that you get weekly alerts every time we post a podcast. Or if you want, you can visit my website, moneyinthebankpodcast.com. And if you want to reach out with any questions or further comments, please email me at Angie@moneyinthebankpodcast.com. I look forward to hearing from you.
Money in the bank.